All right. Good afternoon, everybody who's based in either Europe or South Africa, as well as good morning for those that are listening in from the United States. Today's webinar is going to cover leveraging interpolation for revenue growth, specific to the context of renewable energy. And just as a kind of a brief overview of the checklist today, we're going to walk through 5 high-level topics. The first one is, what is data interpolation? Second topic is, why is so much data missing and what is the financial impact? Third is, what are the hardware approaches to missing data? Fourth is where data interpolation itself makes sense. And then we're going to walk through a data interpolation case study with one of our clients in Nigeria. So just as a brief bit of housekeeping, just make sure everyone to turn off your camera as well as microphone. I'm likely going to actually turn off my camera too, just from a latency perspective. You can also, at any point, feel free to type questions in the chat, and this is meant to be somewhat interactive. So if you have questions, I can very quickly kind of run through them and answer them, and you don't have to wait till the very end of the Q&A to do that. But we will also have some time at the very end for Q&A, where we can have a more sort of open discussion about things. And just as a high level about us, Asoba, our mission is to ensure 100% electricity availability across Africa. And for us, what that means is not just always on, but also from an affordability perspective. Because as we're looking at the continent, over 45% of the population does not have regular grid access. And so we see that as the key to driving true economic development across the continent. So our vision for that is to essentially optimize essential public utilities, in particular, renewable energy systems, to unlock the sustainable economic growth for Africa and the world. I know it's kind of a common thing to group us as a climate tech kind of company, and I know renewable energy is generally seen as that, but for us, renewable energy represents the best possible opportunity for economic growth on the continent. So diving into our first topic of what is data interpolation, and very simply, it is the art and the science of estimating unknown values between a series of known data points. And the graph on the bottom here is kind of illustrative of that point, where we see essentially a series of non-continuous data points, and you see a couple of different curves that represent what that data relationship might look like. And that's essentially where the art of data interpolation comes in, because you're essentially making some educated guesses about what the true shape of the curve is, and then you're identifying an approach to actually filling in the rest of that curve based on what you think the shape of that curve is supposed to be. And based on that, when we say this is both in science and art, right? The art is sort of understanding what model to use, and the science is the actual implementation of that model. And there are a lot of different approaches that you can take to interpolation with lots of different complexity, starting from linear interpolation, sort of that traditional y equals mx plus b type of curve, to more complex algebraic approaches like polynomial and C-spline interpolation, which is sort of the picture that I showed in the slide prior. And then we also have more advanced statistical techniques, machine learning techniques, and even artificial intelligence. Now, from the standpoint of DERMS, or distributed energy resource management systems, you see interpolation have kind of 2 primary roles, and they're roles that kind of build on top of each other. So they're not really distinct in a discrete kind of way. Now, the first role is filling in gaps from your sensor data. So DERMS systems rely on sensors, whether they're inverters, whether they're data loggers, whether they're smart sensors, in order to actually capture data related to production, as well as other important variables or data points that will be helpful for making forecasts or executing whatever business process your role is within the value chain. And so the benefits of interpolation from a filling in gaps perspective are things like essentially reconstructing the missing data. So you have all these different techniques that I mentioned to actually do that. And the idea here is that it maintains data set integrity. So you need a continuous data stream in order to do your downstream business functions with the data that's being generated by these devices. And really, these gaps are coming from things like the sensor being down, there are communications failures. In other words, your network falls out, and then you might also have environmental disruptions. And we'll get into these data gaps in more depth in a subsequent slide. Now, the other role of interpolation is really around enhancing the energy production forecasting that you're able to generate. Um, so the forecast accuracy is of central importance if you're an energy trader, or if you're an IPP that's selling electricity to aggregators who are going to sell it on. It's also really important if you are a utility, like a municipality or a municipal distributor or a municipal utility company as well, right? You need these continuous or complete data sets that allow for your forecasting models to actually perform reliably. And this also helps reduce the error margins when you actually do predict your energy output from your solar panels, from your wind turbines, et cetera. Right, and your operational impact from this is pretty immediate and is pretty substantial. You have the ability to optimize your grid management or your network controls operations, and then also you have your financial impact from that. Now, I want to take the example of South Africa just to kind of have sort of a closed marketplace, because I'm gonna get into some numbers to kind of illustrate the impact of data interpolation in this problem of missing data. So when we look at the South African grid specifically, we see from 2021 or between 2021 and 2024, about 6 gigawatts that have been brought online. It's by far the most of any country in Africa. And in fact, if you combine much of the continent, it's actually more than much of the continent combined outside of Egypt. And you can see that it's growing at about a 32% compound annual growth rate. So it's extremely fast, and it's not slowing down right now. The government's bid to deregulate the market is in fact accelerating this pace. The encouragement of private electricity wheeling also has provided some strong incentives, both for investment as well as increased generation capacity onto the grid. And on top of that, you see that wind and solar, so solar in particular, are the cheapest electrons in Africa, and will only get cheaper. So again, there's added incentive to provide more electricity, particularly when you talk about the kind of goals that we have, which is the increased affordability of electricity for everybody on the continent. Now, from the standpoint, though, of missing data, we have a lot of problems. So from the context of the amount generated, we see that we have just under 8 million megawatt hours per year that's generated from this 6 gigawatts of electricity. And this is kind of an order of magnitude number. The actual capacity factor, the actual production, degradation, things like that, the actual numbers is going to be a little bit off from that. But what I'm really trying to get at here is an order of magnitude estimate of the total number of megawatts or megawatt hour per year that are generated. And this translates to about just under 400 million USD of total annual revenue, if we assume about $50 USD of revenue per megawatt hour. And again, these numbers are meant to be illustrative in order of magnitude. They're not meant to be exact, but we source a lot of our data from Green Cape, which is a very excellent data analysis organization that has a very strong overview of the renewable marketplace in South Africa. Now, so why is this important? So what we're trying to get into here is understanding the financial impact of this missing data, so that we can better understand from a concrete perspective what the benefits are of interpolation, as well as other techniques of improving this coverage of data. So we look at NREL, which is an organization from the U.S. government. I think it's under the Department of Energy, that has a massive data set of electricity generation, of energy use, and more across the United States. And based on their estimates, with complete high quality sensor data, renewable energy forecasting models can achieve about a 5% error margin, or 95% accuracy rate, right? So even with ideal conditions, you're still going to see about a 5% error margin on your forecasting from data that you're gathering. So when we think about the context of missing data, in particular, when we in the African context, where we see, on average about 33% of a data set from a given day that's missing, and in some cases, in our case study, we'll see that it's actually substantially worse than that. We see that the error margin triples effectively to about 15%. And that implies a potential revenue discrepancy of about $60 million a year. Now, again, this is in the most optimistic of circumstances, right? There are going to be, again, if we're just assuming a 33% missing data rate, we see a 15% error margin. Realistically, though, when you have generation that has substantially worse data gaps than that, your error margins are going to be substantially bigger. So why is so much data missing? So I alluded to this a little bit earlier, and there are a lot of different reasons why we're seeing so much missing data. So one is that, and this is probably the most common that we see, is that there are just sensor malfunctions or there are calibration issues. And this comes down to the quality of installation. And unfortunately, that isn't an aspect of solar and other installations that we do see in South Africa as well as across the continent, is that there are a lot of installers to a certain extent. Part of the reason why the margins of development right now are not as high as they were, say, 10 years ago, is because there are so many groups that are trying to install solar systems. And what we do see is that there are a lot of EPCs that do not have operations and maintenance built in. So they come in, they install, and they leave. And they're getting panels from wherever, right? So they don't necessarily have uniform or consistent procurement practices. You don't necessarily have access to the best quality in terms of manufactured materials. Then the installation itself may not be sort of up to par from a quality perspective. So there are just lots of reasons why, just from the get-go, your installation may set you up for failure from the standpoint of actually collecting missing data. Another massive issue that we face on the continent is intermittent network signal. And the reason why this is such a massive issue is that most of these devices, the way that OEMs kind of structure things is that they're continuously sending data in anywhere from sub-minute intervals to 3 to 5 minute intervals to the cloud. So you're getting these packets of data that are meant to represent 3 to 5 minute chunks or 10-minute chunks of data collection that are sent to the cloud. Now, some OEMs also store data on the device. Some OEMs do not. So if you do have intermittent network signal, the OEMs that are not storing data on the device, you basically lose that data. For OEMs that do store data on the device, depending on how they've structured the firmware and the operating system within the device, some of them do have the capacity to properly timestamp so that if there is intermittent internet signal or 5G signal or even 3 or 4G signal, you're still able to get the complete data set when it does eventually upload. Now, there are limitations on some of these OEMs. So some of them only keep up to 1 hour or 3 hours or 5 hours of data. So if you have downtime for longer than that, then again, you're out of luck. And again, some of them, the way that they configure the data upload, if there is a period of time where you're not able to upload, they may not properly timestamp the data. So you may end up with, yes, they are storing the data, but you may end up with, data at noon. Then you might have a 5-hour gap because the internet signal is down. And then at 5 p.m., you may have a massive spike, a massive data upload where all the missing data between noon and 5 p.m. was aggregated and sent all at once. So you have this wide range of different approaches that OEMs take to managing that intermittent network signal. And all that means is that you have a very messy or patchy data set that you end up with at the very end in your cloud upload. Third is that you may have communications in your data transmission. So this has more to do with the actual protocols, network protocols that are used for actual transmission of data. So if there are issues with the cable setup, et cetera, then you may actually just have packet loss that is due purely to protocol errors. You also have environmental factors where you may have extreme weather that impacts the sensors and their ability to function properly. And then you also have either scheduled maintenance or unexpected downtimes. So the first step is to always look at hardware solutions to data gaps. And broadly, there are 4 high-level hardware solutions that you can take. So one is to introduce sensor redundancy, which means that you're installing multiple sensors in order to cross-validate data. And this is a good approach because then this allows you to then verify whether your problems are actually with your sensors versus with your transmission versus with the protocols you're using, et cetera. We also then, look at improved sensor quality. So you may move from one OEM to another OEM, which again addresses some of the issues that I mentioned in terms of how they actually handle issues with network downtime and so on. Another approach is regular maintenance schedules to ensure optimal sensor performance. So essentially you're adding another step to your O&M. So it's not just about making sure that the panels are working or that your inverters are working or the cables are configured properly, but you're also now looking at the sensors themselves to make sure that they're operating at top quality. And then there's also the addition of data loggers and data logging systems, which provide backup storage and error checking capabilities. And so this is sort of adding an additional layer on top of your existing inverters or other sensors that acts as kind of a fallback or a fail-safe to ensure that your data is actually accurately captured. And if there are network signals, it's properly time-stamping things so that when it does send back to your cloud system, you do have a continuous data stream that is properly time-stamped. So all of these solutions are very high quality solutions that have been shown and demonstrated to be very successful. Now, as you might imagine, there are limitations that are primarily financial around this. So they do involve rather high capital expenditures, whether it's installing additional sensors or it's upgrading your existing hardware. It can be cost prohibitive, particularly if you have a very large portfolio of assets that you do have to manage. And I'm going to use our client in Nigeria as an example. They have about 20 megawatts of solar under their management, but that's spread across about 55 sites. So you can imagine that a lot of these sites are actually quite small in the kilowatt scale. And some of them are actually under 100 kilowatts. So you can imagine, trying to add a state-of-the-art sensor to an 80 kilowatt system. From the financial perspective, it just doesn't really make sense from a CapEx standpoint. And it's also rather challenging when you have an already built system to start then layering on additional sensors on top of that. Typically, the time at which you would want to upgrade your sensors is the time at which you're actually constructing the asset, because that's the easiest point at which you can swap out different specs and things like that. So beyond the capital expenditures of actually procuring the devices is the OpEx around operational and maintenance costs. So whether it's frequent calibration, whether you're replacing sensors more regularly, whether you are maintaining sensors in harsh environments and having to fix things because of weather events and things like that, it does increase your operational expenses, and it does create additional create additional risk vectors that you do have to manage and incorporate into your financial model, which you may not have done when you did the initial penciling of the project to build it. And then lastly, you have scalability issues. So when you need to retrofit or expand a legacy system and you add new hardware, it often disrupts the original economics of what you had initially intended for that generating asset to provide. And so that impacts your IRR, it impacts your return on investment. And especially during a time of rapid capacity growth, when you're trying to add to your portfolio aggressively, retroactively adding new CapEx onto projects that have already been built and penciled becomes a financial disaster in many cases. So all of these limitations do then create financial incentives for a focused approach on data interpolation. And data interpolation can be seen as a cost-effective interim solution. So either you're waiting for sort of Moore's law to impact the cost of CapEx, at which point it can be much cheaper to then start implementing sensors, or you're waiting for things like degradation of your initial sensors, in which case then you can replace them, and it's a bit less CapEx intensive to do it that way. It reduces the need for hardware upgrades in between those periods of time where you do see it as financially viable to upgrade your hardware system. And this allows you to then get that continuous data flow that you need for your downstream business activities. And again, that kind of ties into that second point, which is you want to maximize your return on your existing investments. And again, your existing investments were penciled in a very specific environment with a very specific set of assumptions. And again, throwing on lots of new hardware kind of disrupts those calculations pretty substantially, because again, you're adding new CapEx and you're also adding new OpEx in terms of the operation and maintenance. For that, you also have to then calculate depreciation of these new devices that you're adding and so on. And again, you can see how disruptive that is to the original economics of the project. And then what this also helps with is mitigating against unforeseen downtime. And so I mentioned before that there are lots of different reasons why you might have downtime, from weather to unforeseen network issues that prevent upload, to other sort of fault issues with devices and so on, in terms of sensors rather. And this allows you to provide a more robust backup method to ensure that you still do have either continuous data streams or at least a continuous data set when you're actually looking at your uploaded data in the cloud. So in order to give an example or an illustration of what this looks like, I'm going to point to one of our clients that we're working with in Nigeria. This is the same client that has about 20 megawatts of solar under management across Abuja, Owerri, Lagos, and I think a few other cities. So this is a company called Beta Sun Power. They were previously based in Owerri, and I think now they've relocated to Lagos. They have a number of clients, hospitals, schools, some entertainment venues, and so on that they're serving. And so, they have solar, either rooftop or field-based solar, ranging from 25 kilowatts to about 250 kilowatts in terms of size of individual assets. And so what we did for them was we looked at a period from October 1st to December 31st of last year, 2024. So we looked at a 3-month period. And we looked at intervals, and so they're intervals. I think this particular inverter was a SolarMan inverter. And so they had intervals that ranged from 5 to 20 minutes. And so notice that the intervals in the data set were not consistent. So they were not consistently 5 minutes. So there were some intervals that were 5 minutes, some were 13, all the way up to 20 minutes was the biggest interval. And again, that reflects the fact that the inverter itself was capturing data on a much smaller time frame. But in terms of the intervals of upload, so what the SolarMan inverter did was essentially aggregate at the anywhere from 5 to 20 minute interval, but it was collecting data, I believe, on a 10, 15 second time interval. So again, that just gives you a sense of just the wide range of variance that you might see in terms of these different sensors around how they're aggregating these time blocks. But in order to address, and I guess one other important and critical point here was that just over 52% of the data points were missing across these 3 months. And so there were some days, in fact, where you would only get maybe 2 or 3 hours of data, and the rest was blank. And it wasn't because the inverter was off. The inverter was on consistently the entire time, but that was such was the extent of network interruption issues that this site was facing. And this site is it's not a particularly rural area either, right? There are some sites that our client has that are in rural areas, but this was a site in the middle of Owerri, and it had 52% of the data points missing. So this is again a common problem that you're going to see across the continent, and it's a problem that needs to be addressed. And again, just kind of reiterating this idea that it's very challenging, particularly for a client like this, to with 55 or so sites that they're dealing with, it's very challenging for them to upgrade and add expensive new data loggers or expensive new hardware components to these systems. And some of them, it's just not cost effective to do that. Like a 25 kilowatt solar array, it doesn't really make sense to install state of the art top of the line smart sensors. So this is where, from a financial perspective, Interpolation made a lot of sense, and why they were so enthusiastic to take this approach. So to address the issues that we identified here of a substantial over half of the data points missing, we applied a version 1 of our interpolation, which is a C-spline interpolation approach. So this is more of an algebraic interpolation approach to fill in the gaps and to aggregate the data into more uniform 60-minute intervals. And so for our purposes and for their purposes of forecasting, 60-minute intervals was sufficient. Like, they didn't need 10-minute intervals or 20-minute intervals. What we've seen is 30-minute intervals tends to be the smallest time block or time interval from either a trading perspective or an IPP perspective. And so we kind of focus on that just to keep things very simple. So you can see here an illustration, and I'll kind of walk you through. Let me see if I can zoom in a little bit. I don't think it lets me in presentation mode. So I'll see if I can use my little pointer here. So the purple lines that you see are original data. and the yellow lines you see are interpolated data. So you can see that there are some days where, as I mentioned, there were only a couple hours of day where they actually had data. So you can see like the beginning of October, and actually most of October, in fact, you actually see, oh, actually, that's cool. Most of October, you actually see that was actually a huge percentage of the interpolation that we had to do. So towards the end of the year, we started seeing much better signals. So there was less in an individual day that we had to throw in, but there were certain segments at the beginning of this data set where it was essentially, we were interpolating the entire day. And then you see a little bit of November and mid-November that's also kind of similar, right? So there were certain segments or certain chunks where it was very problematic around capturing that data. So we had to be, very careful about the interpolation approach that we took in terms of filling in the data. We had to essentially reference prior data sets. We had to reference equivalent sites to be able to get a sense of from this missing day where we only have 3 hours at the back end of the day. What would that curve typically look like this time of year with, given the irradiation and the weather data that we have, working backwards from there. So again, that introduces a lot of guesswork, and that does introduce a lot of error into that as a result. Because like I said before, interpolation is both a science as well as an art. The art comes in to accurately or adequately predicting what the true shape of the curve actually was, and then identifying the right model to actually then massage that curve from the data points that you do have available to you. So some quantitative insights from this analysis. I think the most important to note was, one, that, as I said before, 52% of the original data was missing, and we were able to fill in 100% of the data. So we do have a complete data set from this. And I want to point you to mean absolute percentage error, which for our purposes is the most important accuracy metric. But this basically tells us is that we're about 70% accurate with the interpolation that we've done. Is effectively what this is telling us. So we were able to introduce a substantial increase in the quality of their data for them to then take forward in terms of building forecasts and so on. And I guess I'll touch on that in a little bit. But just from a benefits perspective to the client, as I mentioned before, we see improved forecast accuracy. And from the high level metrics that I talked about in South Africa, right, where we say that under optimal conditions, we get about 5% error rate in the forecast under optimal conditions. So great sensors, data uploads are great, all of that with robust monitoring, everything. We can still expect about 95% accuracy for the forecasting. So, and as I said before, we estimated about 33% of all the data across the entire market is missing. So when you have a client that's missing even more than that, you can see how substantial the actual forecasting accuracy difference is when you do add interpolated data to that data set. And so again, this allows for not only improved forecast accuracy, but it also helps optimize the utilization of energy, and it improves decision-making from the standpoint of, these guys aren't in energy trading. They're a straight IPP with direct PPAs to their clients. So they're not really engaging in spot markets or day ahead markets. But if they were, aggregating from a series of IPPs and then reselling onto power pools or reselling as an energy trader to, say, municipal buyers or national grid buyers, right? The enhanced decision making does become much more important, because then they're able to accurately project, this is the kind of contract that I can take on an hour ahead basis or on a day ahead basis. And so again, this is our version 1, which was a more algebraic approach, laid the foundation for more advanced solutions, which we're in the process of building right now, which is an AI-based model for our V2. So we used a C-spline interpolation approach. Again, we got this mean absolute percentage error of 30%, and it improved our forecasting accuracy by just over 50%. Now that sounds great, but like I said, with that much missing data, it becomes very challenging to create really good forecasts. To be honest, and one thing that I will say a lot, and I can't say it enough, And I think it's in part because, there are so many people, particularly where I'm from, Silicon Valley, that that treat AI as sort of the cure to all evils, or the cure to all problems in the world. Is that AI is not magic, right? We still have the same kind of problems that we have with machine learning and data science, 10 years ago, which is if you have garbage data in, your output is going to be garbage, right? It's not going to enhance bad inputs. So if you feed it bad inputs, you're still going to get bad outputs. What that means is, yes, it's good that we had, a 70% accuracy rate for the interpolated data that we have, but we can't be satisfied with that. We need to be able to get to a 90 to 95% accuracy, because that's where we're going to really get the level of improvements to forecasting, where we can get as close as possible to sort of that ideal or optimal state where we get about 5% error under all perfect conditions. So that is what our goal is essentially with these AI-based models, is to reduce our mean average percent error to below 5%. Right? So we want to get really high fidelity reconstructed data. We want to be able to capture these complex situational production patterns that even machine learning approaches cannot do this. And this requires a leveraging of transfer learning from other sites. And I think this is actually the most important part from an AI-based approach, right? Is that it's not just about taking data, a patchy data set from one site, throwing it at a model, and then taking the output and calling it a day, right? The way that you leverage the power of AI in this particular case is that, and this is where the benefit of this particular client is that we have, 54 other sites that we can then also use as part of the AI modeling approach to actually extract and ultimately produce really high quality interpolation, which then leads to really high quality forecasting. So we leverage transfer learning. So we say we have 54 other sites that are very similar to the one that we're trying to interpolate for right now. So if we can take some of those daily deviation patterns on the same time of year from all these other 54 sites, we can use that to enrich the approach that we're taking already in terms of the specific methods that we're using, even if it's an AI-based method, for example, like a GAN-based interpolation approach, to actually refine the missing data that we're taking from this one site. So by leveraging what we can learn from other sites, we can enrich the AI-based approach on the one site that is in question to get a much more accurate forecast, much more accurate reconstruction of our interval data, to be able to lead to much more accurate forecasts on the back end. And so again, this kind of leads into, I'll just kind of very briefly describe sort of our overall platform and overall system, right? Where interpolation is sort of the step one of a three-step process, right? Where the very first challenge that pretty much anybody who is generating electricity from some sort of renewable asset, whether it's solar, whether it's wind, whatever, everybody is going to have some percentage of missing data. Everybody. So the question then becomes, okay, how do we enrich that data so that we do have complete data sets, so that we can move into this next step of being able to generate forecasts, and from there being able to generate either dispatch decisions or make better business decisions about how we're going to be contracting that electricity or selling that electricity to our downstream users. So the first step is data interpolation. From there, it's real-time data monitoring and ingestion. So on a real-time basis, every single day, we're connecting to all of these IoT devices and sensors, pulling in data, regularly interpolating that data as it comes in, regularly generating forecasts as it comes in. And then the last step from the forecasting as well as dispatch decisions is that once we're able to then generate these forecasts, we're then able to also provide decision-making around dispatch, depending on what role that you play within the value chain. So for example, if you're a network operator or a grid manager, and it's your responsibility to not just generate or distribute, but to also accurately determine where electricity needs to be routed at any time, at what volume, to which off-takers, it then becomes important to have a tool that can autonomously support you, because at the end of the day, we're essentially transitioning from a system where, in South Africa, using South Africa as an example, we're transitioning from a system where there was one generator, Eskom, who had 6, 7 different power plants, and distributing from those 6, 7 power plants to all of their buyers across the country. We're moving from that system, where it was a handful of people in a network controls room managing the grid for the entire country, to now having tens of thousands of distributed energy resources that are all independently exporting electricity, some to the grid, some to municipalities, some back to ESCOM, some directly to other buyers, right? They're all using the same transmission lines to do this. So now you need to have much more autonomous decision making, because you can't get away with having somebody sitting in a control room in Joburg managing all of this routing for the entire country. Now you need something that can support and augment those efforts, that can operate autonomously. And so that's the platform that we provide network operators to be able to do. All right, so I'm going to pause here. We have about 20 minutes left in the scheduled time. I want to just sort of open the floor up for any questions that the people on the call might have.
Hey, Shanghai, I'll jump in. Sorry if it's okay. So I have two questions. I have one context question and one more specific question to what you've shown us. So the first question is, from our perspective, we are brokers, but we are developing also some profiling tools allowing us to basically be able to anticipate, to forecast what will be next year's electricity usage of the end consumer, for instance, but also the production of the solar farm or wind farm based basically on historical data. And I just want to understand a little bit more, how do you, on your side, use your tools to forecast? And do you basically do what I just described, or is there like an additional part to it? That's the first question. And the second question is, I'm curious, and I'm not sure I got that from your presentation, which was great, by the way. Thank you. Fantastic, superb, like a lot of very important stuff there. But the second question is, how did you manage to do the interpolation at the end of the day? Did you basically use symmetrical data? Did you use like, I don't know, for instance, April, the data from April, and you used it for October for a solar farm and added some weather forecast events to it? How did you use the data?
Sure. All right. So starting from your first question, sort of essentially, how did we do the forecasting and sort of what that process was? It was very simple. We capture as much historical data as possible. So typically the way that we like to start is by getting at least 12 months of hourly or sub-hourly interval data. From there, if we need to do interpolation, then we can apply a couple of different techniques. As I said before, we did the C-spline interpolation. So that's actually a pure sort of algebraic interpolation. So we're not actually taking historical data or anything like that. We're essentially looking at from the art perspective, we take a heuristic about what the shape of the curve should be historically, and we use that to determine the actual exact modeling approach. And that's where we took the C-spline approach for this particular client. And so the C-spline approach is essentially sort of like a polynomial type approach where we assume that there's a polynomial curve on each day, and the extent or the shape or the width of that curve is going to be dependent on things like weather, historical data, et cetera. But we're not actually pulling in any other variables for that approach. We're simply applying sort of an algebraic formula to fill in the missing data points, and then we kind of go from there. But in terms of that sort of broader sort of forecasting piece, right? We take that historical data, we fill in that historical data as much as possible, so we get a 100% sort of data coverage. We then train a model on that historical data. So then what we can then do is what's called kind of nowcasting. So then from that point going forward, we then take the prior 7 days. So we do this every day. So we take the prior 7 days, and then we run it against the trained model that we've already built to then generate the next 24 hours on an hourly basis. And then we can construct, a year's worth or however long going forward we want to do in order to build out that forecast. Now, what I think probably goes without saying is that the level of accuracy is much higher if you're sticking to 24 hours ahead versus 30 days ahead versus 365 days ahead. So we generally don't look at year ahead, at least at this point. We're generally focused on, say, 24 hours ahead or 1 week ahead is typically the trading that we support. But you can get a sense of just sort of like the general approach that we take overall. We can do the same approach to do the year ahead as well. We just, at this point, we just don't, because the clients that we work with in South Africa, Nigeria are really just focused on day ahead or week ahead at most. Now, to your second question, I kind of answered that as I was talking about that first one, but to kind of touch upon it a little bit more, I mentioned that the algebraic approach or the geometric approach is one that is purely geometric on the data set that we're sitting in front of us, and we're only using that historical data set to give us a sense of like what particular geometric approach to take. Now, with the AI-based approach, that's going to be quite a bit different. In that one, we will take a wide range of variables, including weather data. And in particular, we're looking at things like, for solar, we're looking at things like humidity, cloud cover, general irradiation, surface temperature. We try to get temperature of the inverter as well, if that's possible. We also then try to also get data from as many other similar sized sites in the general same geographic location as possible for that transfer learning approach, right? So all of that will enrich the data set to allow us to get a much more accurate interpolation of the data set. Hopefully that makes sense.
Yeah, it does. That's super clear. Thank you.
Have any other questions? All right, that's okay if not. We're going to be posting this video on LinkedIn, and I think it's also going to be on our YouTube channel. And so if those of you that are watching this sometime in the future do have questions, you can feel free to drop comments below the video, either on YouTube or LinkedIn. You can also send us a question. I think my email address on this? No. My email address is Shingai, SHINGAI @asoba.co. And I'm happy to kind of sit down and talk more in depth about this. I can talk about this stuff all day. But thanks again, everyone, for showing up and taking some time in your afternoon or morning to watch this webinar. We'll see you in the future. Our next webinar is going to be in April of 2025, and I believe we'll be covering a policy chatbot that we have developed that helps us manage political risk. So thanks again, everybody.
Thank you.